Michael, what are some things that you don't like about infinite banking?
Yeah. I think one thing is something that, it is what it is, but it's something that ultimately, the benefits outweigh the cons.
Right.
Whenever I make a new decision, usually I do just a little exercise where I have a piece of paper. It's not anything super fancy or sexy, but I put a line down the middle of the piece of paper. I have pros on the left, cons on the right. I write them down, right? The number one con, at least for me, was the time in which it takes for you to actually get to the point where the policy you're taking out more than you're putting in, right?
Mhm.
Granted, that depends upon there are a myriad of factors that determine that, in regards to how the policy is built, et cetera. But at least for me and the policy that you built for me, Anthony, it's actually not too long, which is fantastic in comparison to like the average policy.
Mhm.
I think it was something, correct me if I'm wrong, like 4 to 5 years for mine or even less versus the average policy that I see on the market is close to like 7 to 10. I'm not the expert, right? You guys are, but that's what I would say. And then the second thing is, which I would love if you'd be willing to take this, Anthony, because you had a perfect answer to this. And I feel like this could bring value to the listeners as well, is kind of the difference between direct and indirect recognition. I know it now because you explained it to me and kind of
Mhm.
how that functions into it. Because I've spoken to some advisors before and they're like, oh, you're in a direct recognition. That's bad. That's horrible. You're going to end up doing bad long term when that's just not the case based upon what you showed me. So I think that would be super helpful as well. But yeah, if that makes sense. So those two things. But yeah.
Michael, I love that you are turning the interview
Mm.
around and asking us questions. And to put a little
one,
cherry
one.
on the top, you're like, Cameron, this is not for you. Okay. Do not answer,
Cameron.
Cameron. This is for Anthony.
I
Yeah,
love it.
yeah.
I love
I'm
it.
not gonna lie, I
Okay.
smirked when you're like, Anthony had a perfect response. I was like, man,
You're
Okay.
like, oh man.
So Cameron, there's two types of companies that apply dividends, and it's either called direct recognition or non-direct. And in essence, a direct recognition directly recognizes that you have a loan outstanding. Non-direct does not. And the difference is they direct recognition company may apply different a different dividend rate for the cash value that you have loaned out. Non-direct will pay you the same dividend whether it's max loans or not. And the initial reaction, which is what I had as well, is why would I go with a non-direct? Because I'm planning to do banking and I want to use these policy loans and put the money to work. I want to maximize the dividends, right? But we have to do the math. Now, what I've seen is most of these direct recognition companies tend to pay a higher dividend.
Mm.
So and part of it can be from the insurance company's perspectives, it gives them some more ability, to manage rates and to manage loans. So they if they're able to earn a higher rate than the loan rate, that's hindering the performance of the insurance company. But with the direct recognition company, that kind of manage that will minimize that. But to me, the bottom line, like I said the other day, the bottom line is the bottom line, which Cameron loved when I said that.
it's a nugget.
Yeah, we have to do the math.
Mm-hmm.
And what we've done the math multiple times is if we look at a direct recognition company versus non-direct, I tell you the direct recognition company we use typically outperforms the other carriers,
Yeah.
which is why we use them. Uh, but also, one thing I want to keep in mind: this direct recognition company pays the least commission.
Mm-hmm. Mm-hmm.
Okay, so
Yep.
which when you're comparing, I mean that's one of their larger expenses, and they have their commission expense is going to be less than others, so they already have an advantage, and they can pass that along
Yeah.
via the dividends. But what we did is if we ran the math, just solely looking at the illustration, typically the direct recognition company is going to outperform. However, since we're planning on taking loans, that's not a fair assessment. We need to take into account the impact on a potentially lower dividend. So what we've done is we did the math and we did a max loan every
Yep.
single year, right? So we can truly see the impact on what potentially lower dividend is going to have. And what we found when we ran the math and then we look at age 70, numbers are just about the same.
Yeah.
Right. So
Mhm.
what that did for me, because part of this, if we're going to use a direct recognition company, we need to make sure that it's best for our client. And so we
Mhm.
did the math to show, even with the max loan, we're going to be in the same spot. Okay.
Yeah.
But also, it's going to be rare that you're going to do a max loan every single year,
Yeah.
right? You're going to keep
Mhm.
some money in there as well as you should. And sometimes you may have very little loans in there. So thus you will get a higher dividend. So thus you will end up being ahead. And also, Michael, as I told you, there's a lot more that goes into picking a company than the dividend rate and even what the illustration looks like. Because, for example, Michael, I know when we first met, you actually had a policy with another company, which is a great company. They are a good company, right? But one of the reasons why we don't use them is they have limits on changing the PUAs. And for example,
Yep.
I mean, so that particular company, either you can only make a change on your anniversary, and how often are you going to have a financial issue where you need to lower your PUAs or your premiums? Rarely is that going to happen right on your anniversary, right? Or what that company will do is you can pay PUAs 3 times a year, which typically isn't that conducive. Most of our clients were typically doing it on a regular basis. And what's interesting, Michael, you've ran into some cash flow issues where we needed to lower or drop the PUAs temporarily in the middle of the policy year. And because of the company that we chose, they have the flexibility of the PUAs. And I think we need to take into that, which even if the other company may be illustrated better, if we don't have that flexibility to change the premiums when we need to, who knows what, I mean, maybe we end up losing that policy or something negative or some more stress is going to happen.
Yeah, no, really good answer there. But I would say, at least for me in particular, it seems like that's a common fallacy in the industry. At least when I talk to other individuals, it's like that's what a lot of clients are hearing is direct versus non-direct recognition, right? That's kind of like amongst other things. But I feel like that once somebody actually understands IBC a little bit more, that's the thing that's the kicker. It's like, okay, that's the next kind of hurdle to get across to learn a little bit more. So that makes sense. But Cameron, I don't want to let you.
No.
Oh, go ahead.
Yeah, I was going to jump in there. I was going to say there is a level of education that needs to be communicated to clients on direct versus non-direct. And once somebody kind of goes through and understands the differences between the two, like Anthony said, is at the end of the day, a lot of times they end up being really, really close. Right. And so that is the takeaway. And what I tell everybody is that if you look at the industry, right, is if one was better than the other, the entire industry would go that way. Right.
Yeah.
But because we've got direct and non-direct, that tells me that, hey, they're both going to end up in a pretty similar spot. And so there should be some intangibles that also are factored in there. Right. Anthony mentioned some of them just on the funding, some of the kickstarts and stuff that you can put in there. So great point.
Here's one thing I found when you're dealing with an agent on their stance between direct or non-direct, it's going to happen on what company that they sell for, right?
Yeah.
If they're
Yeah.
Direct recognition, non-direct recognition company, they're going to tell you non-direct is the only way to go, right? And if they're a direct recognition, they're going to tell you it doesn't matter. For us, we're not independent. We're not tied to one insurance company. We work with multiple ones. So we have a direct and we have non-direct, and we don't decide to use which company based on the dividends. It's more based on your situation. How much flexibility do you need, and how are we going to design the policy? That for us is what's going to determine the best insurance company for you.
And additional, I'll add on there is that I think the prudent measure, right? If someone's doing infinite banking, typically they're going to have several policies. I think a prudent measure is to have a portfolio policies that's made up of direct and also made up of non-direct. So
yeah,
it solves all the issues. Yeah.
Michael, were there any? So what I heard is what things you don't like about IBC was what we call that slow start, right? Where a dollar in takes a little bit for a dollar out. And we kind of handled the direct versus non-direct. Were there any other things you don't like about infinite banking or going through our process?
Yeah, no, I don't really think so. Yeah, those are really the only two things. I would just say, yeah, in regards to the knowledge sharing in the industry, that was better than I thought it was. So in regards to opportunities, I think it was something I was discussing with you, the opportunity that I mentioned the other day, and it's something like, yeah, let me look into that because it's something we might, be interested in offering our clients. So that's not like a bad thing. It's actually a positive, but I do like kind of the knowledge sharing in the industry, in particular.
You want to see the entire episode? Click here. If you want to learn how investors use infinite banking to increase their returns and lower their taxes, click here. If you want to see if infinite banking is for you and you have some questions, hop on a discovery call with us and one of our coaches. The link for that will be in the description.